Ladies and gentlemen, good day and welcome to Bata India Limited Q4 FY22 results conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitin Bagaria, Company Secretary, Bata India Limited. Thank you, and over to you, sir.
Thank you, everyone. Good evening. Good to have all of you on the call. I have with me Mr. Gunjan Shah, who is Managing Director and CEO. We also have Vidya Srinivasan, who is Director of Finance and CFO. We have already made the presentation, disclosed it to the stock exchanges. I hope you have had the time to go through it. I request Gunjan to take us through the commentary on the presentation, and then we will have a question-answer round and address as much as possible. Thank you. Gunjan, over to you.
Thank you. Thanks, Nitin. Hi, everyone. Welcome to the investors call. As Nitin mentioned, I hope you have that presentation. I will obviously quote the slide that I'm on when I'm talking so that we are all in sync. Starting off, there's obviously a standard disclaimer on slide 2. Moving on, we will obviously cover, it's a pretty standard flow, so I don't expect any new induction on the flow per se. So starting off with the business overview, obviously Bata India's most loved and trusted footwear brand. We've got almost close to 1,600 now EBO stores in about 650 or 640 plus towns. And in addition to that, we've got a widely expanding multi-brand outlets as well as e-commerce reach. Brand awareness stands at a stratospheric 84%, pretty high by any brand standard and definitely in footwear. And within that, consideration stands at about 54%, which is also pretty high in my understanding of consumer brands. We obviously have market penetration, so all of this is spread all across India. We don't have a great skew in any specific region, and also across market tiers, so whether it's metro, mini metros, as well as the smaller towns. And we obviously offer product offerings that cater to various usage segments as well as price segments. Yeah. So moving to slide number 7, ladies and gentlemen, I have talked to you about this bubble chart, right? This is broadly the strategic thrust levers that we have, agreed upon as an organization and a leadership, and this is something that we are continuously working upon. I have shown this chart to you all multiple times, so I will not go through each of the bubbles, but I'll try and go through the table on the right, which is key highlights and progress that we would have made on some of these levers in the quarter and the year gone by, largely the quarter. So the first one in terms of portfolio, I think our merchandise and portfolio has significantly now left COVID and its backlog. We did have obviously over 2 years a significant backlog in terms of new entries, innovation, and I've spoken about this. I think there's been a complete refresh that we have largely progressed on. And I think one of the biggest ones in terms of portfolio evolution is sneakers and casualization. Within that, sneakers has been a concerted effort across the organization, right from designing collections, manufacturing, sourcing, as well as obviously marketing, as well as rollouts within the markets across our outlets. This has resulted in a significantly accretive growth in sneakers for us in the quarter gone by, and we do see continuous traction on that. So hopefully we will keep continuing that and keep riding the wave on sneakerization and casualization also in various parts of our brands and portfolio. The second one, which was an expansion, I had talked about 2 large levers where we will see a significant outsized expansion that we will push. So we have seen almost about last 2 quarters now about 20 to 30 franchise store additions. Last quarter also we had about 22 new franchise stores, despite COVID and the disruption that happened in the first half of the quarter. And we expect that pace to continue. More about it, I think, in subsequent charts. And simultaneously, we are expanding a multi-brand outlet division, and that's giving us great dividends. There has been, again, a significant progress over the year as well as the quarter gone by. Bringing marketing investments back, I think this was in the context of COVID, but we continue to accretively add in marketing investments. Versus last year, we would see obviously significantly outsized market investments. But we would have, I think there were a skew within the quarter. We did hold back marketing in the month of Jan, but February onwards, we had a rollout of significant campaigns. One was the continuation of the Unlimited Sneakers campaign, which we had done in quarter 3. In digital, now it went on all mass media, which is television. In addition to that, we also rolled out in the quarter neo casuals for neo leaders under Hush Puppies. This was the first ever marketing foray that we have done in Hush Puppies, and obviously giving us great feedback and traction. In addition to that, we have continuously within that ramped up obviously digital marketing. As I said, neo casuals Hush Puppies campaign was completely digital, and that's rightly so because that's where our target consumers sit. Explore digital footprint. We see continuous traction in our e-commerce growth. It is obviously our fastest growing channel by many parameters, and it continues to lead our growth. And in addition to that, our own e-store, while a little smaller from an absolute revenue perspective, but from a strategic perspective is very important for us, and we see this now going forward. I think one of the big levers that got improved upon was getting us better ASPs, which is obviously very critical for unit economics in e-commerce business. We also had taken on board the fact that we need to be a far more agile and efficient as an organization. There is one big area that we've seen good traction, which is in terms of customer returns. It's a big parameter for us in terms of understanding what is the quality of product that we give. It's been largely now codified across the length and breadth of the organization, right from manufacturing in the back end to the stores on the front end, and various actions that come out of the measuring this metric. We have seen almost a 20% reduction in those returns, and we hope to keep going forward on that. The other piece is obviously we've also made our first initiative by opening up a sourcing center in the West for a product category called Sandak. That sells in very large quantums in the West and the coastal belt right down to Kerala. And we used to produce and source it all in the north and ship it all the way down there. So this is something that will not only save us freight cost, but also give us much better turnaround and therefore agility in terms of meeting demand. Staying nimble on costs, several initiatives that have happened on this. 2 big highlights. I think I've spoken on those. Obviously, rent negotiations, we do continue doing that. Not only the inorganic ones which are related to COVID and lockdowns, and we did obviously try and leverage even the Omicron lockdown for rent benefits, but in addition to that, trying to make sure that we become far more leaner in terms of occupancy ratio, the way we go about it. A little more maybe down the line. And the other piece is in terms of while we see increasing traction in demand, footfalls, and therefore manpower requirement in our stores, but how do we try and get the leverage so that we are able to manage the supply of manpower and therefore resources which meet basically the fluctuation in demand that happens throughout the day as well as throughout the week. So that's what we are trying to leverage through flexi manpower. Last but not the least, while multiple initiatives have been taken in terms of leadership, org structures, in terms of creating business units for various revenue streams of ours, a large technology initiative that has been also initiated is that we are also wanting to ensure that we, make sure that our technology backs our ambitions across the value chain and revenue. And one of the big ones has been the inventory management system, which is now being updated with something that can actually make sure that it becomes far more easier for us to make it visible as well as analyze. and that's what is the TRIMS version 2, and that's going to get rolled out by June 22. Yeah.
Slide 9.
So moving to slide 9. So first and foremost in retail, a large part of our investments, let's say in the last about 6 to 8 months, right, including the last quarter, even more accelerated, has been in refreshing our store network. And when we say refreshing, there are multiple ways in which we do it, interventions. One is the largest one, which is a renovation, which is a far more structural change that we do in terms of lighting, ceiling, the fixtures, etc., flooring, etc. So there are a large number of renovations that have happened. We also do minor or relatively a medium renovation, which we call as a facelift, and that also got done in large numbers. I would say that in this first half of the year, we would do one is the largest ever refresh of the network, which was direly needed, by the way, because 2 years we had not invested in our stores. And we also tried out some few new concepts in terms of evaluating how does that respond to customers in terms of modification of our stores. One of them was called Red 2 Plus. So a large amount of our investments and effort has gone into that. We should see that obviously has given us, as showing us signs of traction. And going forward, we would also want to now also keep doing this while simultaneously opening new stores. In new doors, what you see in the segment below, we see basically almost 23 new doors in franchise, or 34 new doors in shop-in-shop. Hush Puppies got addition after a long time of about 2 stores, and Bata company-owned stores added about 6 new doors. These are not necessarily net additions. There are some closures, but yeah, broadly, I think there is an expansion story. This will not only, I think, gain traction, but accelerate hopefully going forward as we see more and more confidence in terms of consumer sentiment. What we also saw in addition to that is that retail recovery, while got muted or dampened during end December as well as the first part of this quarter, but I think February onwards we did see a lot of recovery. One of the things that drove that recovery, as I said, was sneakers. Within that, there was 2 large initiatives that contributed to it. One was Sneaker Studios. I talked about it last time, which is a shop-in-shop within the Bata stores, giving us great response. Last quarter, we were at about 15 to 20 stores, and now December quarter, we were 15 to 20 stores, and now we have last quarter, in March quarter, we are expanded to about 107 stores. North Star was the category that led this entire charge and growth in sneakers and continues to do so. Franchise specifically, I think, I have said about this, I think we've got a large outsized ambition. We want to see this aggressively expand. While doing that, we are also conscious of the fact that we want to make sure it becomes a sustainable growth engine for us. So a like-to-like growth is something that's very, very critical that we keep measuring for effectiveness as well as ensuring that we are on the right track while we keep adding inorganically. On the inorganic front, last year, which is the fiscal year of FY22, I think we saw by a fair margin, I think the largest addition of stores at 75 stores as you see in the graph, which is bigger than even what we saw last year as well as any other year prior. And we hope to see this traction not only continue, hopefully accelerate going forward. We see huge inquiries as well as interest from people across town tiers in terms of franchise expansion. Yeah. Next slide, that is number 10. In terms of the multi-brand outlets, 11, sorry, yeah. So multi-brand outlets, we saw expansion. In December quarter, we crossed about 1,000 towns. We've added another 50 towns. It's almost like to like compared to even addition of distributors. And what you see as WD, I've explained this. This is access to potential. We have ramped it up, right, from 19%. So it's a quarter-on-quarter addition in terms of access to potential, the kind of revenue or the market category size that these distributors do. So that is big, going big. We are also focusing on fewer but larger distributors. And but this also 32% tells you that there is a huge headroom in terms of distribution expansion here. Simultaneously, what we have also done is focused on a few categories while we do this expansion. The growth rates are very strong. We do see growth almost across categories. But however, within that, we've got a few categories where we want to literally own those categories, one of them being men's dress by default. We've got a brand called Bata Remo that's doing extremely well. In addition to that, we have also, while the bases are small, but we have started making extremely strong inroads into sneakers, and that hopefully we'll have much more to talk about as the coming period. Yeah. E-commerce, as I said, our fastest slide number 12. E-commerce, as I said, it's our fastest growing revenue stream, and it is now gaining a reasonable amount of heft also. As you can see, we are at almost 2.5x of what we were, let's say, pre-COVID. Last quarter saw about 11% growth, while faster than the overall company growth, even if I compare it. Right? Relatively, I would say a little muted, largely impacted by January, but I think the exit growth rates, etc., have been extremely accretive to us. And we are looking forward to this. It's very promising. We've got solid building blocks in place across the three revenue streams within this, which is marketplaces, which is our own e-store, as well as the home delivery channel. And all three of them are showing us good traction. We have also beefed up this entire channel with increasing investments. We have obviously created a separate BU structure, which is a complete P&L ownership of this channel. There were two large additions in addition to obviously talent and capability that we have added. One is that we have opened up the 3PL facility, therefore made it far more entrepreneurial, far more agile, as well as easy to scale up. And the other piece that we have done is we upgraded in terms of our technology, and in addition to obviously adding a few marketplaces that are coming along. The one chart that you see on the right is e-commerce complaints. That was obscenely high in my view at about 17-18% till about 6 months back, and that has sharply come down. In my view, even at about 6.5%, it's still very high. You cannot run a business that way. While there is good improvement, our endeavor is to bring it significantly lower, and obviously that's resulting in better traction and satisfaction from consumers. Yeah. Marketing, I spoke about it in my first chart. We released the image on the left as well as the image on the extreme right were the campaigns that we rolled out in the quarter gone by. In April, actually in May, we rolled out our first campaign along with a new brand ambassador, which was Disha Patani, right, which was under the 24/7 casual collection. It's got to be Bata with a a signature tune and a hummable tune, and it's just been rolled out a few days back. I think, and obviously, I think the sneakers performance as well as the Hush Puppies growth, which I might add was extremely strong in the quarter gone by, has told us that this is giving us good traction. And we will continue to invest in this going forward also. And I don't see a reason why this year the marketing investments will be at par or even better than what we had seen in the best in the years gone by. These are just some visuals of the kind of various renovations and refresh that we have done of our stores. You see the one on the left. I think that's a new concept that we have tried. Hush Puppies is anyways a well-known licensed brand that we have, which is doing extremely well. It's one of our largest brands also. In addition to that, Naturalizer, which is another licensee brand that we have for largely ladies fashion. That is something that we have tried out with this kind of a double door concept. It's giving us good signs. Sneaker Studio I've already spoken about multiple times, and the refreshes. Obviously, we have tried out various kinds of innovations, as you can see in the bottom right in terms of the sneakers under power. Yeah. With that, some few other highlights. We also carry, as an organization, pretty strong agenda in terms of diversity. And one of the initiatives amongst many others that we have done is basically open all-women stores. And that's giving us good traction. It gives us a lot more feel-good factor. But not only that, it also makes the stores far more, exciting, and tells us that this also works. So there were 25 all-women stores that we had across India by March end, with a good addition in the quarter. We also won, awards for our loyalty program that we run, and we obviously, as part of our corporate social responsibility, did a large amount of shoe donation to needy and underprivileged people. We show a few other highlights. We did see rent savings, right, for the full year. Large part of it was front-ended towards the first half of the year when there was a large amount of COVID disruption. But even in the quarter gone by, we did see some benefits in terms of occupancy savings. But as I said, I think the bigger one that is a longer lasting thing that we want to leverage is making sure that we are far more efficient on that, whether in terms of structure of our lease agreements or whether in terms of basically our locations. Therefore gets us, as I said, the key metric is occupancy ratio. Regional sourcing I have spoken about. We will see many such more initiatives. There is a big skew in terms of our sourcing versus our demand centers, and that is something that we want to balance out for better efficiencies and freight savings. And the last one I did speak about, we want to ramp up the flexi manpower. That not only helps us cater to demand efficiently, but simultaneously make sure that we have got flexibility in terms of our overhead costs in the stores. Yeah. Revenues, and this is slide number 17. I will hand over to Vidya to take us through the financial summary.
So from a revenue standpoint, for the quarter, we have performed well. If you look at versus, 1 second. Yeah, so for the full year 2020.
Sorry to interrupt, ma'am. Ma'am, you're sounding very far away from the speakerphone. Can you come a little more closer?
Sure.
Thank
So
you.
as far as quarter ended March 22, we registered a revenue 665 crores, which is a growth versus the 590 crores that we registered in the March 21 quarter. The growth of 13% was across all our verticals. So, we broadly grew in retail, franchisee, e-commerce, as well as in non-retail. From a margin standpoint, we had a growth in margin of about 4.5 percentage points. If you recall, in the last quarter, I had mentioned that, the margin drop that we had also had some one-off benefits that has got, one-off impact of approximately 3%, which has got cleaned up in this quarter. But margin growth has happened, which is powered by both the growth in some of our channels, intake margin improvement as well as ASP improvement. Overall, our net profit for the quarter has increased by about approximately 40 crores. And EBITDA has, of course, also been trended upward as a result of the growth in revenues as well as margins. The expenses have been broadly in control.
Right. So while we see these growths versus 2021 as well as the previous 2 years, but the way we measure this is versus 19, which was a pure clean pre-COVID. There we stand at about 98%, as you would very well know. Yeah. So is that the end? Thank you so much. I would love to hear questions and hopefully try and answer them. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Gaurav Jogani from Axis Capital. Please go ahead.
Hi, Gaurav.
Hi, sir. So my question is with regards to the margin. You have said that you're tracking at around 58% gross margins even in the Q1, and historically we have seen that versus Q4 your margins generally tend to go down in Q1. But in this time we are actually seeing a good expansion in the margins, and on top of it we are also seeing sharp inflation in the RM prices also. So if you can help us, why we are shooting up versus the historical trends that we have seen here in terms of the margins.
Right. So actually you are given a lot of references that is sequential as well as historical, but I'll try and see if I can address it as efficiently as possible. So yes, we have seen raw material inflation. That's a reality, right? That we see all across, and we have not been immune to it. But however, we saw indications of this starting right from literally September of last year, And we've tried to do 2 or 3 things, Gaurav, when we tried to address this. Obviously, some of the inorganic pieces in inflation continue even now, which we were not expecting, which is the geopolitical, accentuation that's happened to inflation. But we have tried to work on 2 fronts. One is basically try and tighten our belts in terms of cost efficiency. So there have been multiple programs that have been run on this, trying to look at the products itself, where there's been over-engineering, trying to look at basically in terms of efficiencies, in terms of costs, and freight, as I talked about some of the initiatives. But simultaneously, we have also looked at basically pricing where required. And mind you, we also had in this meantime also the GST hit that hit about 50% of our portfolio. So that also had to get absorbed. All in all, I would say that we have managed to straddle this reasonably well till now. So that's where I would keep that as of now.
So, sir, just a follow-up to this. In that case, as you mentioned, that pricing was also used as a lever. So if you can help us out, what would be the pricing growth that you have taken on an overall company basis for the year FY22?
For the full year, I wouldn't be having so accurately available.
I think between 10% plus.
Yeah. But on an ongoing basis, Gaurav, there has been inflation and therefore price increase to the extent we have seen ASP go up by almost about 16%.
For the year, so that is?
No, on a run rate basis.
Okay. And sir, my next question is with regards to these store expansion plans that you have highlighted. So as I can see, you are looking to expand to around 500 the franchisee stores, and I hope that would be in the couple of years. So if you can help us out, what is the nature of these franchisee expansion? Are these on a COCO or a COFO model? If you can give some details in terms of these franchisee operations, it will be helpful.
Yeah, sure. So I have spoken about this, Gaurav, in the past. Franchise operation is what we call as FOFO. So it's franchise operated, franchise owned and franchise operated, right? So the way it works is that we bring in a credible retail partner, a person who understands retail, understands how to operate it, might not be aware of Bata and maybe footwear, but understands retail and definitely fashion. And basically open hopefully multiple stores under that entity, gradually increasing as the comfort goes up. The way it works is that we work on a complete sell-through model. So that's something that we are very clear about. The third piece is that it basically we make sure that he follows and complies to certain norms of ours. The norms can span across, one is the software that operates in the stores, the kind of merchandise that the store keeps, and lastly, the way the store is, the way the store looks right from the time the person keeps in the capex as well as sustaining it going forward. So these are the broad parameters. I hope that addresses the business model question that you mentioned.
Yeah, sure. So just lastly, one follow-up on this, in addition to that, the RM question that I have linked
sorry
with that.
to interrupt, Mr. Jagani. May we request that you return to the question queue? There are participants waiting for their turn.
Follow-up question, I'm just continuing with the same. Hello?
So there are participants waiting for their turn. I'll request you to return to the question queue. Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in this conference, we request you to limit your questions to 2 per participant only. The next question is from the line of Trilok Agarwal from Diamond Asia. Please go ahead.
Hi, good evening. Thanks for the opportunity. Just 2 questions. One, from a franchisee output perspective, or the way you measure internally, is the performance similar to the existing stores that the company has set up? That's point 1. And the second question, when you have highlighted on the press release about the 11% higher than pre-COVID levels in terms of Q1, is that a function of any mix, but any skewness towards any particular mix, for example, formal wear or school wear, or if you can just make comment on that point.
Okay, thank you. On the first question, on basically how does the franchise compare to, let's say, a company-operated store? Trilok, basically our objective is to ensure it's absolutely seamless. So a consumer is least worried whether the Bata store is, or the Hush Puppy store or any other store of ours is basically either a company-owned or a franchise-owned. So our objective and endeavor at all points in time is that it becomes a seamless experience for the consumers, for the town and the strata and the consumer segment that we are targeting. Obviously, a store in a premium mall in, let's say, Mumbai is going to be anyways different from a store that I might open, let's say, for example, a small town in UP or in Tamil Nadu, right? So, but barring that, we want to make sure that basically it's a seamless experience. And when I mentioned in the previous answer that I gave to another gentleman, is that we put in mechanisms to place to make sure that we track it. I had also spoken about something called Net Promoter Score that we track. And we have also in the last quarter started tracking the Net Promoter Score for franchise operations. I'm pleased to share that the Net Promoter Score, which is a complete third party independently taken from consumers which have transacted or entered into our stores, that is roughly at par. There is some scope for improvement, but it's a minor difference. So broadly, I think all these indicators tell us that we are able to make sure that the experience is seamless. The second question, which was on what are we seeing in terms of growth, in terms of categories. As I mentioned, I think what we see is basically the traction is being driven consistently by one is the sneakers category. So that's one thing that is giving us outsized growth. There is some lumpiness to the school business depending on when the bunching of school openings, etc. have happened. So that is something that, however, is we are still seeing that coming back much better than what we've seen obviously for 2 years, right? The other piece that is also doing reasonably well and which we will see obviously traction going forward is all our comfort brands. So that's also playing somewhat into the casualization scenario, where even consumers who are walking out of their homes after a long time, going to offices, to outside occasions, etc., they like to carry that comfort along with them. And therefore, our comfort brands are also doing extremely well.
Okay, understood. And just just a request, if you can in disclosure, you could start sharing on like-for-like sales for both your as well as franchisee owned, so that'll be helpful. Thank you very much.
Okay, we'll keep that in mind. Thank you.
Thank you. The next question is from the line of Priyam Khemawat from ASK Investment Managers Limited. Please go ahead.
So thanks for the opportunity. In your opening remarks, you highlighted the word sneakers at various junctures. So just wanted to understand what new things have we done here over the past 1 year and what percentage of our overall revenues actually come from this category now?
Can you just repeat the question? What were the various junctures?
Sir, you highlighted the word sneakers a lot of times in your opening remarks that we've done exceptionally well and the traction is really good right now. So just wanted to understand from your part what exactly have we done here over the past 1 year and also what percentage of our overall revenues actually come from this category now.
Right. No, so I think this is one big example that I've also, when we talk within the organization also is a one classic example of cross-functional teamwork. So it's not being just one part of the organization that is driving the sneakers agenda. It is, literally the entire organization. So as I said, the journey started almost from a work perspective almost about 12 months back, accelerated post July onwards, right? And it started with first and foremost basically getting our collection refreshed, right? So making sure that we got far more obviously fresher collection into that. So that was a big agenda in terms of trying to make sure that overall newness goes up. So there is a distinct difference when I go to stores, when others that I've seen or hear, there is a distinct difference in terms of the sneakers that are available in the stores compared to, let's say, a year prior, etc. So that's the single largest agenda that started off. That got clubbed with the fact that basically we wanted to make sure that we also develop capabilities within our supply network so that we are able to cater to the design requirements and the product requirements that we have. So there was a huge amount of effort that gone into not only developing suppliers or sourcing partners, but also maybe even co-developing along with them. And that's seen some very good traction and output, which you can see now. The third piece was to ensure that we also get the entire marketing piece in place. right? And which you can see in the Unlimited Sneakers campaign. We ran that in the November-December period as well as in the Jan-March period. And that's given us good traction. It was a very unlike a Bata kind of an advertisement, and that's given us good response. And the last piece, I would say, amongst many others, has been obviously making sure that all the frontline and the stores were also trained and understood what the importance of sneakers and how it's to be sold. And that is something that has helped us, along with a large amount of effort that's gone into, obviously, the Sneaker Studio initiative that I've talked about.
So thanks, that was very elaborative. What percentage of our overall revenues actually come from this category now?
It's about 20%.
Okay. Sir, if you could please help me with the volume numbers for FY22 and FY20.
I don't have it handy right now. We'll try and see if we can revert back to you during the call. Okay?
Okay, thanks.
Thank you. The next question is from the line of Aniket Sethi from ICICI Securities. Please go ahead.
Hi, thanks for the opportunity. Sorry, I'm not sure if I missed your comment on this. You have mentioned that a pilot has been launched in the open value-added range in the distribution channel. Can you discuss the strategy and the price points here? And how do we fare vis-a-vis the competition in this sub-segment?
Yeah. So basically, this is so this was a portfolio segment that was empty. So one of the things that we have done, right, is also making sure that the collection and the merchandise team of ours, right, regularly in a disciplined and a cadence manner visits markets and their consumer segments in a way. Right, so the retail team does that, and therefore even the distribution business team also does that, right? And when you do that, there is obviously a science way in terms of tapping opportunities, looking at competition as well as consumers' demand and gaps that you can get feedback from the market, the customers, distributors, etc. One of those opportunities was basically a value-added open segment, which I would say, let's say, something akin to, let's say, outdoor or a little more rugged sandals that we did not have earlier. And that is a portfolio that has got developed under the brands of Power as well as under Power largely. Yeah.
And these products we don't really have in our existing retail.
We didn't have that segment at all. So I mean, to put it very glaringly, we had most probably, I think, one or two product offerings which was minuscule and doesn't make sense at all, because you need a certain amount of critical mass of range to make sure that an outlet buys into you and therefore displays and shows it. So now we've got it obviously multiplied dramatically, and I don't think we have reached still competition levels, but we would be in the range of about 15 to 20 articles by the time this quarter gets over.
Understood. The second question is, see, we understand that sneakers and casualization have been front drivers of recovery for Bata. While you did share the overall recovery numbers, but I believe some of the sub segments may still be trending lower. If you can discuss some of the products which you are defocusing or which have seen a weak recovery compared to pre-COVID levels, that will be really helpful. Thank you.
I would say that there is nothing specific. I think if there is something that would be specifically not recovering as well, that would be the kids' footwear ex-school, right? Which is I think tracking a little lower, right? But that also we are seeing increasingly the traction coming back on that. But that would be one segment, because even non-footwear of ours, which is significantly margin accretive, has also done well. So yeah, so that's where it stands.
And if I can just have a follow-up on that, what is the breakup of kids with school and non-school wear, which under the Bata brand?
It would be about the kids would be in the range of about just slightly lower than 10% for the full year, while there is a skew for the school business, right, in certain periods, but broadly about slightly lower than 10%, equally split between school and normal kids footwear, which is bubble gummers largely.
Okay. Thank you so much. That's it from my side.
Thank you. The next question is from the line of Resham Jain from DSP Investment Managers. Please go ahead.
Hi, good evening. So I have a broader question on the MBO business. I think you have highlighted awareness and consideration level is quite high, and which means that the ability to place your product in MBO should be higher. So given that, and I want to know the percentage also, what percentage of your revenue comes from MBO, and will this part of your business has the potential to grow at a much faster pace than the company average? And again, related to that is how do you think this segment can grow for you? Because it might be under-indexed as of today, given the brand awareness which Bata has. So yeah, just a broader context on the MBO business, if you can put forward your broader vision here. Thanks.
Right. So you'll have to help me back with the questions if I've forgotten, but broadly it contributes to about, I would say 13 to 15% of our turnover right now. So it's not insignificant, and therefore it materially impacts the growth of the company, hopefully as it continues to grow fast. The second piece that you mentioned was that there is scope for expansion as well as growth. I agree with you. In fact, as I mentioned, even most probably this time, but definitely even earlier, right, that we see obviously this brand awareness and consideration, making sure therefore also there is a lot of, headroom in terms of not only the MBO business, but also the franchise as well as the digital business, because all of this gives me access to consumers. The second piece, in the MBO business, we also have two parts to it. The larger one is the general trade MBO business, right, which is what I've largely commented and you are talking about. But there is also a reasonably fast growing, very small, but we see a lot of expansion, and I've talked about it this time, I think for the first time, which is the entire shop within departmental stores. And it goes beyond just the, the leading chains. There are many, many more state level departmental store chains that are there. And we are trying to make sure that we penetrate in all of them. I think we made some progress, but a long way to go. So I think both of them are leveraging the same brand strength that you talked about.
Yeah, and what kind of growth? Because 13-15%, if we compare with the kind of brand positioning or the brand strength which Bata has, what is the a long-term ambition here? Will it, this 13-15%, can it become what percentage, or any growth number longer term, if you can share, at what pace it can grow compared to the industry? That's it. Thank you.
Right. So this business has, the industry, the way we see it, wherever we can track numbers, right, it has outgrown the market for the last 4-5 quarters, and I don't see a reason why it cannot continue doing so. So I will leave my comment to that now. But I see this contribution going up only, and hopefully I think not too far out in the future, it should be more than 20% contribution, which means pretty strong growth separative to our overall growth.
Okay, sir. Thank you. All the best.
Thank you. The next question is in the line of Ashish from Ambit Capital. Please go ahead.
Yeah, thank you. So first question is in terms of the growth. So, in the commentary, you said that versus pre-COVID level in the last 50 days or so, the growth has been around 11%. Now, when we look at the ASP, which you talked about, the ASP has gone up by 16%. And in the last 2.5 years, the total number of stores or the doors which Bata operates has also gone up by 10 to 15%. So which basically, if I do a back of the envelope calculation, it suggests that the volumes are, still lower by 8 to 10% versus the pre-COVID level. So is there any particular category where you are seeing, a lower growth, or am I calculating anything wrong here?
No, you're broadly not too far off. I would say that the volume growths on a run rate basis are about 13% or so lower than the revenue growth, right? And that's largely because there is also a mixed play that is there. the franchise growth, I think it was Ankit, right? The franchise growth doesn't reflect directly into the complete revenue because there is a margin takeout that happens upfront to the consumers and therefore net sales revenue, right? And while the retail ASP might be similar, but my takeout ASP is lower at an NSV level. So some of that play does come in. We do want to make sure that the volumes come back also. That's very important. There is obviously increasing traction, etc. And there are a few things that we have done because we've had to take price increases. So there are a few entry price points that we might have vacated. So we are trying to make sure that we get in new articles which can basically make sure that those consumers who were at that price point, etc., we can get them back into our fold in case they're getting disappointed with the new prices, etc. So there's work that's happening on that front, in addition to some of the initiatives that I said that are happening on the multi-brand outlets, etc. Besides the expansion, etc., which will anyways add to the volume growth.
Sure, sir, that's helpful. And just last question is in terms of the COCO or the company-operated stores. So, if I look at the data, quarter on quarter, the number of stores, the company-operated stores has been declining. Maybe, the decline has been between 6 to 10 stores every quarter. So just wanted to understand, is this decline largely, COVID-led that wherever rentals were not there, that is why the stores have been closed? Or is it more because, in this market, you're focusing more on franchisee stores and that is why some of the company stores have been closed in these markets?
So, no, it's not related to franchise for sure, right? These are very different and they are very targeted store and, what we call as trade areas that we go with the franchise expansion agenda and the company operated stores agenda. But however, you are right, there has been a trend of lower COCO stores for the period that I've shown you all. Right, and that's largely a consequence of the COVID era. We've started now adding a priority for the last about 6 months or so had been to first get same-store growth going. So same-store growths are higher than our overall company-owned store growths, and that's but now with the renovation agenda largely in place, a large amount of effort and resources went into making sure that we refresh our current stores and get the same-store growths much more healthier. We now should start seeing even the company-owned stores expand. However, a large part of the expansion, even from a capital efficiency point of view, is going to be through franchise exclusive outlets. So my guess would be that we will have company-owned stores expansion, but it will be about 20% of the store additions that we'll see going forward.
Sure.
At a net level.
Sure, sir. Thank you.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, opportunity. So my question pertains to your comment on sneakerization. Now, if I go through your interviews in last 6 months, you are putting a lot of disproportionate emphasis on this part of the business. So just wanted to know this 20% of current sales to 50% journey, which you mentioned in one of the earlier interviews. Does it mean that we'll be playing across the performance or casual and sports segment in this? And in the performance segment in particular, there's a lot of competition in terms of from international giants who are actually established on that platform very firmly. So what will be the strategy to participate in some of those higher end segments of the category?
Thank you, Tejas. You're right. I think it's a long journey, right? And whichever media source you're quoting it from, I had also mentioned it in the longer term context, right? But the agenda is very clear, and the urgency and the requirement is also very clear because the consumers are clearly moving towards it. But however, we've obviously understood this right or tried to understand this category, and our understanding only evolves and deepens as we go forward. Right, the entire sneaker segment is divided into multiple nuances and usage occasions. One part of it is performance-related usage occasion, but there is a very large segment which is related to casual wear, which is related to lifestyle wear, and which is related to maybe light performance, which is what I call as walking and running. And what we have seen till now, as I also mentioned, is that our lifestyle brand, which is North Star, has seen the fastest traction. It's almost at about something like 200% growth or something like that. A relatively smaller base, however, but continuous traction, and that is something that tells us that the easier fruits to pluck for us lie in that space, which is the latter three segments that I talked about, which is casual, which is lifestyle, and which is walking, running. And we will first and foremost prioritize in that segment. I think we've got so much of headroom right now in that space that there is enough need for us in that space itself. And as we go forward, parallelly, we want to make sure that we work upon, either a sustainable solution which can help us target the performance segment, and there can be organic as well as inorganic ways of making sure that we participate in that. But I'll leave my comment there. But there is enough headroom in this, the lifestyle and the casual segment itself.
Sure. So this was very helpful. So second question pertains to the rapid expansion on the front end distribution side that we are doing. But in past, as a customer and as an analyst, our observation has been that there's a frequent issue of stockouts and then you losing customer not on the design or on the brand part, but on the availability part. So parallelly, as you ramp up your expansion on the distribution side, what are we doing to ensure that the supply chain keeps up the pace with this expansion on the front end?
So two things, actually multiple things on this, right? But I can't speak about all of them, but you're right. From a historical perspective and maybe even currently so, right? I think there is still some way to get to, I would say best in class or best in market kind of situation from an availability perspective. One is that we have obviously seen a significant improvement in availability, the way we track it, which is, we've got a defined matrix for each store in terms of products as well as sizes against it, and then we track for obviously adherence against that matrix. So that score has ramped up over the last 4 quarters. That's one. This is just putting a measure, however. The second piece is making sure that the supply chain becomes a little more agile. One of the initiatives I talked about, there are several more that we are trying to put in place, which help us making sure that supply chain is enabled for it. And there are several linkages to it, making sure you've got a forecasting system in place, you are able to aggregate it into a certain supply buckets and therefore capabilities of various factories as well as suppliers. And the third piece, in this entire piece, technology plays a very large role. And that is also something that I touched upon, but we are also working on several other tools which are basically going to help automate and not only automate, but make us much more efficient as well as more accurate in terms of our deployment of the inventory plan. So that is, I think, I would say in a broad scope of a large agenda that is there on this fact.
That's all, sir. Thanks and best wishes.
Thank you.
Thank you. The next question is from the line of Jignesh Kamani from GMO. Please go ahead.
Thanks for the opportunity. Just adding to what Tejas has asked on the inventory management and everything. So with new inventory management system which we are planning to roll out in June 20th, our supply chain and the front end inventory management will be the best in class in line with the industry, or still we will be lacking? And second thing, if you take about say 7-8 years ago when we tried to implement supply chain system SAP, there was a technical teething issue and we again rolled back to the old system. So are you expect any teething issue this time also?
No, we don't design for teething issues, right? But however, there are obviously learnings that we capture for. And while that happened a long time back in a slightly different maybe scenario, context, etc., right? But however, see, it's very important to note that a tool by itself doesn't solve. There are a whole host of business processes of a large and a complex organization that need to be making sure that they get attuned to leveraging the tool and therefore then seeing the effectiveness and the impact. And I would say that's a journey, but you got to start the journey somewhere. And that is all the initiatives that I talked about. A tool by itself is not necessarily the end all and be all.
Okay. Second question on the price hike and the gross margin improvement. So if you take about, we have witnessed close to around 450 basis point gross margin improvement, probably highest in the Bata industry. And you related part is because of the sticker rise and partly because are you worried that we might be outpacing in terms of price hike competitor and might lose out market share? Because when we do some channel checks, some of the customer indicate that price of North Star or a Power are being slightly higher or much higher compared to other competing brand in this category.
I wouldn't say that you are priced out. But however, as I mentioned in a previous response that I gave, there are price points that are very critical, and it's very important that inflation is a reality. Everyone in the industry is seeing it. People are pacing up, depending on their appetite as well as their objective in terms of taking price increases. But it's a reality, and people will have to take it, if not today or tomorrow. But the point is that we have to make sure that we are able to, address all our addressable consumer segments. And that is what I said, that there is a deep analysis that's happening in terms of volume segments, areas where price points we have vacated, and making sure that we quickly recircle back in terms of our portfolio offerings to ensure that those price points are addressed in a value for money manner. So that is how we are trying to approach it. I think inflation is, as of now, here to stay. So we will have to tackle.
Sure. Thanks a lot.
Thank you. The next question is from the line of Bharat Choda from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, I just required the breakup of the stores that we will be adding, like in FY23-24, how many stores we are planning, and what would be the breakup of the same in franchise and company owned. And also, for my clarification, in the presentation there is something like 1569 exclusive stores, whereas where I see the slide below there are 1812 stores. So what is the difference between the same, sir?
Right. So the second question first, because that's the easier one. The difference is that we have also declared, and hopefully will keep sharing because we are now tracking it far more closely, which is the departmental shop-in-shops, right? And we have marked it out in the table that you saw. So that would account for the difference, right? Within the other question that you mentioned, which is projection or outlook in terms of store additions. As you saw, last year we saw the largest additions from a franchise perspective, but I did respond to someone else that our COCO stores still come down, and that is something that will get reversed, and hopefully franchise should accelerate going forward because we expect this to be a clean operational year. We are getting our act right. We understand this much better. So that should give you some kind of an indication. I can't give you numbers beyond that. But I also mentioned earlier that we should see broadly on a slightly longer term scenario, right? We should see basically a ratio of about 20% and 80% in terms of company-owned stores and franchise stores in terms of net additions.
Okay. And sir, one more question, like a bookkeeping question. Like basically, I just required this rental pre-Ind AS rental figure for FY22. I think in FY20 it was somewhere close to 385 crores. So what is this number in FY22?
I will hand over to Vidya to answer that question.
Sorry, I didn't exactly catch your question. What was your question?
Then the pre-Ind AS rental expense for FY22.
Can you just repeat that question, please?
I can't hear your thing.
Yeah, I am asking for the pre-Ind AS 116 rental expense for FY20. The number was 385 crores. So what is the number for FY22?
Yes.
Yeah, it's around the same level actually, because what has happened is that we've been able to do a fair bit of rental renegotiation, etc., and we also have some rental closure over the last couple of years. So frankly, for this year, more or less, we are at the same level.
Okay, thank you, ma'am. That's it from my side. Thanks for answering my questions.
Thank you, Bharat.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Nitin Bagaria for his closing comments.
Thank you for your interest and for joining this call. We look forward to interacting with you in coming times. In case you have any further queries, you can write to me. My contact details are on our website. We'll be happy to entertain. Thank you.
Thank you. Ladies and gentlemen, on behalf of Ambit Capital, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.